Todd Mark, thank you for being with us.
It's an honor.
Listen, at what point did you begin to see people coming into the agency giving foreclosure as a reason?
The real foreclosure crisis that we've seen, not just in Dallas, but across the country, was 3 to 3.5 years ago. And that was the start of, we're seeing people who are having trouble with subprime mortgages. It's basically payment shock. Folks that could afford their mortgage in years 1 through 3, years 1 through 5, it gets reset once, it's uncomfortable. It gets reset again, it's unbearable, and their entire monthly budget out of whack, and they're having trouble just keeping up with their priorities. Now we're seeing majority prime mortgages, people that are dealing with loss of income and that really drain their savings from other crises, and now we're underwater. So it's the recession kind of catching up with everyone else.
At what point in this crisis do you find that they come to you?
Certainly we see a vast majority of people who come later than we wish to see them. And of course, the later you are in the process, the less options.
Why do they wait so long?
You know, there's a lot of reasons why. Some folks think of collection agencies for credit cards, and they say, I'm just ignoring all of it. Well, when you're behind on your mortgage, this is a secured debt. And if you don't talk with your servicer or your lender, they've got no choice but to take the house back.
Maybe there's a belief that they can do something to turn it around?
But as we know, with unemployment, nationally near 9.5%, and it's still escalating, and of course it's on the rise here in Dallas, there isn't the same hope of an immediate turnaround for folks.
So when you find yourself in that situation, you come into CCCS, what can you do for them?
The first thing we ask, are you current on your mortgage? They may come to us thinking, I need to talk about these unbelievable credit card debts. If they're behind on their mortgage, we say, that's relevant, but we're going to put those aside. We're not going to talk about that today.
So how do you start to keep the home?
We'll go through 3 basic things. Their income, and talking about if there's a change, if they're unemployed or if they've been underemployed. We'll look at their monthly expenses, make sure that they're living within their means on a monthly basis, and if that's changed. We're going to look at all of their debts, and if they're behind on their mortgage, we say, what's the reason for default? Was it a situation, a divorce, a layoff, a medical catastrophe, or death in the family? Is it lack of a financial plan and somebody's always living just a little bit beyond their means? Or is it this newest category, payment shock, the resetting of an ARM, an option, a hybrid loan, where they could afford it before and it's unaffordable now?
Of the situations you mentioned, which is the one that could most likely lead to preventing foreclosure?
Well, it used to be that there were only those two areas, like lifestyle, living beyond your means, or a situational debt that they didn't have emergency savings to prepare for. This new area, this payment shock, is really a subset of what's happened in the mortgage industry and with the housing crisis. But it's not just a subprime, it's not a bad mortgage issue anymore. This is where a multitude of effects have come into place. Somebody may be in a great mortgage, but without income, without a job, it's truly unaffordable housing at that point. So needing to figure out where they were to where they are and what's truly affordable, how they can improve their situation. If it's a lack of income, we're going to talk about how can you increase income. Is it getting a job, getting part-time on the side, getting a second job? Is it getting additional training or schooling to make you more employable? Is it just waiting through until we get through this rough time in the economy?
But in the meantime, isn't it a case of whether the banks are willing or lending institutions willing to cooperate
Absolutely.
to help you keep the home?
Sam,
and are you finding them to be cooperative?
Now, certainly in the last few years, we've had many programs come down from the government meant at stalling off foreclosure and saving homes, and some of those have not worked out. A lot of that is because the servicers, banks did not want to participate. But with the new Making Home Affordable program from the Obama administration, and of course because there's bailout money coming to help these
starting to see a
lenders,
change?
yeah, there's suddenly pressure to play ball, but there's also actually financial incentives with this new Obama program called Making Home Affordable. And if anybody's interested, they can go to the government website, makinghomeaffordable.gov, which outlines the 2 newest options, which is affordable refinancing and affordable loan modification. The whole idea is that there's a lot more incentive for the banks and the servicers to give loan modifications, to set up repayment plans. And they never wanted to put people out of their homes. It's not their business model. They want to keep people in their homes. But now there's more skin in the game, and they're like, all right, even if it means taking a loss, if it's reducing interest rates, if it's spreading out the amortization period of a loan, if it's changing it from an ARM to a fixed, they would rather do that than see it go into foreclosure.
For those who have not gone through this situation and want to avoid it, what kind of planning should they be doing? How should they be managing their money and finances to avoid this?
Today, the most important thing you need to have is an emergency savings. You always hear have 3 to 6 months put aside for a rainy day. If you don't have savings put aside, you need to have a plan put in place of how you can start building that up. The other thing, Sam, is we need to make sure consumers are prioritizing their expenses. Always, when you're making your monthly payments, your mortgage number 1, your car number 2, your utilities number 3, food number 4, necessary insurance number 5, and then you cut off. Everything else falls below. So make sure you're paying your priorities first and you're not covering your lifestyle or luxuries.